Hello and welcome to the ASX Top 50 video market update for March 2018. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstance and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, Managing Director of Investor Signals. The topics for today, we look at the global macro backdrop driving equities. We roll through the ASX Top 50. We look at FY 18 earnings with a particular focus on what FY 19 earnings and dividend forecasts look like. We conclude with a review of our model portfolio holdings and a short-term market outlook. The ASX Top 50 model portfolio, where we have an algorithm engine that generates the buy and sell signals. Up on screen here is the performance of the model over the course of 2017. It delivered a time-weighted rate of return of just over 22%, which outperformed the XJO by almost 10%. If we look at how that model's tracking for 2018, and since the 1st of January, the graph on screen shows the performance benchmarked against the accumulation index, which includes dividends. So the blue line being our algo model and the yellow being the accumulation index. So you can see here that we've started to outperform from early February, and it's delivering an outperformance of roughly around 4%. Now, as a subscriber to our technology, you can get access to the model portfolio buy and sell alerts, or you can have us manage the account for you. Up on screen is an example of an email that you receive. So this was a recent closed alert in the portfolio. So after holding NAB for 622 days, we've had a sell signal on it. The percent return was 21.74%, and then on top of that, there was $2.97 in dividends that were also paid. If we go back a little bit further, this was an open position, so whereas NAB was a closed position, Oil Search was added to the model. If we go back a little bit further, Orica was removed from the model. Now, to give you an idea, these Orica, the removal from the portfolio occurred at the end of January, so you're often only getting sort of 1, 2, 3 trades a quarter. It's not a very active trading model. It's more designed for superannuation funds as an investment approach to the market. To subscribe to the technology, we're offering a special introductory offer where you get access to the professional level at the investor rate. And if you'd like to take advantage of that, please call our office on 1300 614 002 or visit the Investor Signals website. Moving straight into a graph of the Dow Jones. So volatility has returned to global and domestic equities in February. The initial catalyst for the sell-off was the increase in inflation and, I guess, concerns around bond yields in the US. And that really all started in early February. Going forward, I think we're going to face competing forces between sort of the outlook for inflation and rates and versus robust global growth, so where we still have a relatively encouraging backdrop for earnings. In saying that, I think something that investors need to be mindful of is in the early part of 2018, we're starting to see softer manufacturing data, and then we have these emerging trade tensions which are adding a little bit of fuel to volatility in markets. So when we look at a graph of the Dow Jones, we had a 10% sell-off. It rallied back about 60%, and then it's faltered again. Now, whether we come back down and test this low, only time will tell. But I think what is evident is that high PE valuations, increased macro risks suggest that on probability, the market's more likely to trade sideways than re-establish a strong uptrend. And therefore, investors should be thinking about the mix of defensive versus growth assets in the portfolio, and importantly, looking at how you can add a derivative overlay to enhance the returns. So in today's recording, we'll take a look at what stocks we think should be in a portfolio and which stocks should be out. And before we do that, let's just look at the XJO. So the Australian market fared a little better than the US in the context of the percentage sell-off. Our rebound ended up being very strong thanks to a slight recovery in banking shares and strength in resources. Iron ore in particular has been very strong, and we've just seen the market starting to soften a little bit in the last few sessions. Let's move straight into a graph of the top 50, and we'll move through those and identify the algorithm buy and sell signals and just have a look at the earnings growth and dividend yield. So AGL, we're buyers of this at 21.50. We think the stock's good value, 5% dividend yield, 14 times earnings. Buy it here. Look to sell covered calls on a rally back up to $24. Aristocrat should deliver 8% earnings growth. AGL should do. Aristocrat, this is in the model following the algorithm signals. It's had a consistent high, low pattern. Aristocrat growing earnings about 18%, 22 times earnings on a 1.8% dividend yield. Starting to look a little bit expensive, but momentum still favours the long side there. Amcor, we think, like AGL, this is good value. It's oversold down here at 15 times earnings on a 4.5% dividend yield. Owning it here, looking for a move back up to around $15, where we look to sell covered calls to enhance the return. AMP, this is in the model portfolio following the buy signals down the bottom here, and the stock's continuing to perform well. ANZ, so also in the model, but back on support here. The Australian banks, as we're all aware of, trouble growing top-line revenue, real focus on cost control, started to get a little bit of buying interest over the last week or two, simply supported by an attractive dividend yield and franking credits, but it's likely to remain a difficult environment for banking shares to trade too much higher. APA Group, not doing there at the moment. We can see the algo sell signal, so we're still on the short side of that. ASX delivered a good earnings result, probably came in a little bit above market expectation here. On a forecast basis, they've guided towards 5 to 6% earnings growth, so it's helping to support a very high PE here at 24 times earnings and a 3.7% dividend yield. We continue to like ASX. It's gone ex-dividend roughly $1.07 today. So any pullback in price, we look to add to ASX position. AZJ now, at the end of last year, this was a stock that I was warning that the payout ratio is too high and is susceptible to a sell-off. We had the algorithm signal flag, the lower high structure. It was in the model from these buy signals back here. It was removed on these sells, and since then you can see how far the stock sold off from 550 back down to 430. So it's not a stock that we have in the model at the moment, and we won't look at that again until such time as it re-establishes higher highs and higher lows. BHP, we like this name. We think this continues to be a cornerstone stock in portfolios. We last had an algorithm buy signal here at around $28, and we continue to sort of think that that sort of finds support there. We have it trading about 13 times earnings on just under a 5% dividend yield. Brambles, whilst we're attracted to this name and we think it's getting a little oversold, we're mindful that it's still actually got quite a bearish structure of lower highs there. So again, it's not until it actually turns around and starts making a higher high and higher low. In the case of Brambles, it's on 18 times earnings and a 3.3% dividend yield. CBA's been recently added into the model portfolio following the algorithm buy signal just before it went ex-dividend, so we've collected the dividend and remain a buyer of CBA on this support here around 76. When you think about sort of the trend within the Aussie banks, they're roughly down 20% from their highs of sort of 2 to 3 years ago, and over the last 12 to 18 months and they're now trading on the support of that consolidation range. And in the absence of that revenue growth, we think them likely to mostly bump along sideways where they are at the moment. Computershare, we're cautious on this name. We think it trades on a very high multiple and only on a 2.4% dividend yield. It looks very expensive. CSL, terrific, strong earnings result here, much better than the market expected. They're growing earnings at around 34% 4%, which is above where the market was pricing. The market was looking for around 20% earnings growth. So that extra earnings growth is the explanation behind the share price acceleration from 140 to 160. And the outlook for CSL, whilst the stock's expensive at sort of 34 times earnings and a 1.5% dividend yield, I think any future algorithm buy signals is justification to continue to add to the CSL position, and it's one of the better performing stocks in the model. Caltex, on a forward basis, we're likely to see maybe not much more than about 3% earnings growth for Caltex. So for us, we're not willing to take another look at this unless we see it on lower price levels. It's 14 times earnings and a 3.5% dividend yield, and maybe back at around sort of $32. It starts to become good buying, and we'll comment on that one on the blog. Dexus, we actually like this at 15 times earnings, 5% dividend yield. We think a lot of these real estate stocks have been oversold and are now bouncing off support. So on that basis, what we're saying is we don't think interest rates in the US are actually going to move higher as quickly as the market is pricing in, and that'll give some headroom for these property stocks to recover. Fortescue, we hold this in the model. It's been one of the sort of underperformers within the model, but at this sort of 480 level, we think it's attractive, and there's an argument that that should be on your radar there, with maybe a stop loss back below 450. Goodman Group, one of the property stocks, growing about 6 to 8%, 3.3% dividend yield, rallied off this accumulation, off the algorithm buy signal here, and looks to be moving higher. GPT Group, keep this one on your watch list at around 470. It should find support and start to move higher. It's starting to consolidate, and we've got the algorithm buy signal there and the stocks in the model. Insurance Australia Group, we really like this name. It's one of the only stocks, I think it is the only stock in Australia that Warren Buffett's ever invested in. They're growing earnings at a tremendous rate. The stock trades on about is expensive now, back down at a 4.2% dividend yield and trading about 18 times earnings. But just to have a look at that earnings per share growth into FY 19, we're expecting earnings per share to accelerate up to, say, 44 cents, which places the stock, as I said, about 18 times earnings and just over a 4.5% yield. So a lot of the good news is priced into Insurance Australia Group, and we really don't want to have another strong look at it adding to this position until we get the next algorithm buy signal. So we're expecting to see some consolidation in Insurance Australia Group. Incitec, so it was added to the model following the sell-off here. Incitec is a beneficiary of stronger DAP prices, which are feeding through to higher earnings. We have the stock about 16 times earnings on a 3% dividend yield. You can see the support that we've marked in there at around 350, and we're looking for the stock just to consolidate sideways in the near term. James Hardie, we've removed this from the model portfolio following these sell side signals here, and we're thinking that the stock starts to run into resistance at around that $23 level. Lendlease delivered a really good earnings result. Share buyback is the market views favourably at 14 times earnings, 3.7% dividend yield. We think the stock's getting a little bit expensive. The algorithm signal's flagging the sell, and it was removed from the model as a result of that. A Mirvac, it's a buy down here at around $2. Now, this is not our preferred property stock. Our preference is certainly GPT over Mirvac, but we've had the buy signals there at around $2. Mirvac trades on just over a 5% dividend yield. Medibank Private, so I actually like this name, albeit recognise that it is expensive and not much in the way of revenue growth. So we think that investors should, where they own this name, sell tight covered calls to enhance the return and push that income from 4% up to 10 or 12% on an annualised basis through adding that covered call. Macquarie, we're not doing there at present. NAB, as I mentioned earlier in the recording, this was removed from the model. So after owning it back in June 2016, increased 21% plus dividends over that period, and the algo engine's just flagging that we're now into a lower low, lower high structure. Newcrest, so this has recently been added into the model portfolio. We can see sort of a consolidation through here, and we're looking for the stock to actually move through the top end of that resistance there. Origin Energy, we like this name, 14 times earnings. We're looking for the company to reinstate the dividend in the August period, and we can see the continuation of the high low pattern here. We got supported around 8.25, so owning the stock above that and maybe thinking about a stop loss below it. Orica was removed from the model. You can see the price actions rolled over, created lower lows, lower highs. We've got the algo sell signal there. And at a closer look, what we're thinking is that maybe it moves up, fills this price gap, but at around 18.50 runs into resistance and moves lower. And that's something that traders could keep an eye on there as a potential short trade in portfolios. Oil Search, so we like this name. We recognize that it's broken out, made a higher high, now higher low here, and at around $7 we're looking for it to find support. Trades about 19 times earnings on a 2.3% dividend yield, and at around that $7 level, look for the shorter term momentum indicators to turn positive, and we think that could be a buy. It certainly sits in our model portfolio following that higher low formation, as does Qantas. Qantas is trading at around 3% dividend yield at present, and at about $9 it seems full value, and we would look to maybe buy back in on a pullback there, but with Qantas. Kiwi Insurance, so we can see here the structure still remains negative, lower lows and lower highs, so that not doing anything there at present. Ramsay, whilst this is a very defensive business and it's a attractive asset at 22 times earnings and a 2.3% dividend yield, we think that the stock may actually move a little bit lower before it creates a buying opportunity. So we can see here that you've actually got that lower low, lower high structure, and it's not until that starts to break back out that we look to add that into portfolios. The resources have been the real strong performers in the Australian market, and most investment banks and portfolio managers continue to have a overweight allocation to resources into 2018, based on the expectation that synchronized global growth continues. We are in a period of weakness at the moment for these resource names, and it's a little early to tell whether we actually get a more substantial retracement, in which case we're likely to see further algo signals highlight that it is a buying opportunity. But in the case of Rio, it sits in the model portfolio following the buy signals back in March of last year. South 32, likewise, it was added into the model in early 2017, and we have South 32, probably out of all the resource names, I think South 32 is maybe at the margin a little less attractive than BHP and Rio. South 32 trades on 11 times earnings and a 5.2% dividend yield, but may not see the same type of forward earnings growth that BHP and Rio will see. Centre Group, so where bond yields started to move higher in the US, we've seen the sell signal here in Centre Group, and the stocks moved from 450 down to 390, so it's not in the model. Stocklands has been added into the model, and we're looking for the stock price to improve coming into the June dividend. We have Stocklands on about 12 times earnings and a 6% dividend yield, and we're thinking that it could trade up to around $4.40, at which time we'd either take profit or look to sell covered calls over it. Sonic Healthcare delivered an okay earnings result at 21 times earnings and a 3% yield. The stock's expensive, and we're looking to buy back into Sonic if we can see a move back down to around 22.50, and you can see the algo sell signal just at the top there. Santos, looking for this to find support at around $4.70. Suncorp, we're negative on this one following the lower low, lower high pattern. You can see the resistance line there. Suncorp trades about 17 times earnings and just over a 5% dividend yield, but on a forward outlook, probably not likely to see too much in the way of earnings growth there. Sydney Airport, so we continue to like these defensive yield names that have been out of favour over recent months, and we think both Sydney and Transurban are a buy opportunity. We've been expressing that on the morning blog. So same there with Transurban as a buy coming into the June dividends. Telstra, so the recent algo signal there flagging the lower high pattern has turned out to be a correct signal. The stock's sold off, but certainly if you look out 1, 2, 3 years, we think Telstra's a strong turnaround story and ultimately delivers far better return to shareholders. And patient investors could wait for the accumulation signal to flag a higher low formation and generate a buy. And that's something that we'll continue to keep an eye out. And that's one of the advantages of being a subscriber, is you automatically receive the email when Telstra is added into the model portfolio. So it just acts as a reminder that the higher low formation is developing. In the case of Treasury Wines, certainly bullish pattern here, high highs, high lows, one of the standout earnings results. And we continue to sort of see the momentum move higher there. Vicinity not doing there following the sell signal. Westpac, as with all the major banks, back on support, but it is in the model portfolio. Wesfarmers support here at around $40. The earnings result came in a little bit shy of expectations, and the stock trades on about a 5.5% dividend yield where it is at present. So we're not thinking that there's too much to drive Wesfarmers higher in the short term, and to the extent that we own it, it's a good example of where you want to be adding a covered call to complement the return. Westfield, we think this finds support here at around 8.50 and starts to move higher. Woolworths, let's just jump back and have a look at this. Woolworths has been removed from the model. The earnings result met market expectations, but I think the recognition that price pressures are increasing and the likelihood of Woolworths being able to materially grow earnings when it trades on a 20 times earnings, 3.5% dividend yield, it would appear that sort of fair valuation's back more at around $26.50 than it is at higher levels at the moment. So in the case of Woolworths, if we see it back at, say, $26.50 or $26, we would see that as an opportunity to enter Woolworths. Woodside, once the discounted rights issue washes through at around $28, $29, Woodside looks like reasonable buying to us, and it sits in the model portfolio, and there we are back at the index. So within the market, I think the message is for us that the banks are on support levels, but they've been there for the last few years, so it's hard to see the catalyst to drive those higher. We recognise that the growth is in the resource names, but the short-term momentum appears to be moving lower. And as we generally go through the top 50 stocks, there's not many companies that are really sitting in strong buy patterns at present. Where we do see value is in a couple of the oversold yield-sensitive names. But the advantage of having the algorithm model is there's a broad base exposure there to roughly 35 or 32 names within the top 50 stocks at present. Thank you for listening in.